welcome to the Astranti Top 10 Most Likely Unseen Issues for the May 2016 Management Case Study on opticians company Optical. So before we start, I'm just going to go through a bit of an introduction to this particular video and where I've got the information on and what you need to do with said information. So how have I come up with these top 10? Well, first of all, you look at the focus in the pre-seen. If there's a lot of material in the pre-seen on a certain topic, then it's likely that there is some kind of importance of that topic. It's likely to be brought up in the exam, so there's more to talk about. And that feeds into the second point here, the degree of importance attached to it by the examiner. But that particular section extends beyond purely what's in the pre-seen, but also what CIMA like to examine. For example, ethics. It may be that there's no real mention of ethics in the case study, but ethics is considered very important by CIMA, and therefore they are likely to examine it. Next is the strategic importance. How important is it to the organization? If a certain topic is very important to the company, for example, say their suppliers. If they rely very heavily on a certain supplier, then it's likely that there might be an issue on the supplier. If something were to happen to that supplier, what impact could that have on the business? And also, just a more general experience in doing these videos in creating mock exams and reviewing exams in the past, the typical kind of issues that come up, and what kind of things have the examiner brought up in the past. And my final point here is about how easy it is to write issues on that subject. The people who write the exams are obviously people too, and they will go for ones that they know, that they can write good questions on. So what do you need to do for these issues? Well, first of all, it's important to prepare key models. So this will be things like your SWOT exam, like SWOT analysis, like your PESTLE analysis. Because building up this information now will help you to adapt the new information given you in the unseen, or help you to have that context to apply the unseen material. Next thing you need to do is practice exam questions on these issues. This will help you to understand the kind of questions that will be asked around these topics and how to answer them. And also, this next section here, it will help you to plan these answers in your mind so that when you go into the exam and you start writing, you'll already have a background in which to apply this new information. You'll already have certain points to bring up in your head as you're writing for them. And I've also put some more generic things here, such as the advantages and disadvantages of these certain topics, where they would be used and how models can be used to support them. So let's move on to the top 10 issues now. So my first issue is funding. Now, the reason why I've chosen this is because it is a commonly examined topic, and it's also a great way for the examiner to test F2 knowledge. And it links to key topics such as equity funding, debt funding, cost of capital analysis, and dividend policies. It also ties in with other topics such as new investment for projects. So for example, if you've got a new project, a new opportunity, but you do not have the cash available for it, an add-on to that could be how do you raise the funding for it? And so certain issues that are likely are things such as the purchasing of a new piece of machinery. We know that Optical is a very capital intensive company due to the nature of the industry itself. So it could be that the company is looking up to set a few new shops, and then of course it also has to buy all that expensive equipment for each of these shops, and the whole project may cost a lot of money. And it's particularly likely to be relevant to perhaps a larger investment, such as the acquisition of another company. Now we know from looking at the statement of financial position that actually the company only has a limited amount of cash resources at the moment, and to purchase another company could cost far more than that. Therefore, the company will need to raise additional funding. And you may also be asked more of a technical question on the different types of funding methods. So it's important that you learn all the different types of funding, the different types of the funding that the company could use, and also which ones would be most relevant for the organization. Now, for example, IC Optical is a large listed company, therefore equity financing is a possibility. If you were dealing with a very small company, then you would perhaps be looking more at debt funding. Another question that could come up is on dividend policy. Now, as a listed company with shareholders, dividends are something that are relevant. And of course, you have to consider what effect paying out dividends has on your investors and on the company itself. Now, if you put yourself in the shoes of a shareholder, some shareholders may want dividends and some shareholders may not. Now, the ones that may not may be younger, employed professionals with decent salaries from their current jobs, and therefore they wouldn't want dividends because of the high tax rate on them. They would rather gain in equity from the share price rising. Whereas if you are a retired person who uses dividends as a form of income, you would want dividend payment. You also have to think about the signalling effect of dividends as well. So this is what how the market reacts to you paying out dividends. Now, when a company pays out dividends, sometimes the share price actually goes down because the market reacts by thinking that the company doesn't have any plans for the future, any new investment opportunities. And also, the fact that all this money has now left the organization means that there is less money within the organization, and therefore the organization is less valuable. So some points that we can bring up from the case study here: that we do not have that much cash available for investment. Now, on the balance sheet, it only registered 90 million C dollars in cash and cash equivalents. Now, that may seem very high, but of course, it is a very expensive industry. And on top of that, you cannot just assume that all of that money is purely available to invest as the company sees fit. They may have a strategy in place where they have to have a certain amount of bumper cash for a rainy day, so to speak, or they could have some other projects that money has already been committed towards. We could also look at the fact that their debt funding at the moment, their debt was only 25.7% of their equity. Therefore, the company is only a quarter financed by debt financing, which makes it easier to take on additional debt funding. This, of course, being different from the main competitor NewSpec that had more debt than equity financing, and therefore it would be far harder for that company to raise additional funds because the bank would look at the company and think it's too much of a liability. But of course, as a listed company, they could also raise additional funds on the stock market by issuing some more shares. Obviously, you have to consider your current shareholders and your current stakeholders when you do that, because obviously they don't want you to issue more shares because it dilutes the value of their shareholding as such. If you've got 100 shares in your company and one person owns 10 of them, then they own 10% of your company. If you issue another 100 and sell them to someone else, then their 10 shares suddenly only becomes 5% of the company. But one thing they could use for additional funds, both as a security against more debt or to just sell outright to raise funds, is their assets. Now, you know from the balance sheet and the cash position that they have a fair amount of fixed tangible assets. Now, of course, you also have to consider that maybe these cannot be sold because a lot of these came from shop fittings, optometry equipment, and the buildings themselves, which of course are all necessary to the organization. So here's the order in which you should consider raising funds if you are given a project or question that requires raising funds. Now, the first port of call should always be to possibly use the cash that you still have available. Of course, we know that they do not have that much cash, but if it's only a very small project, it could still be fundable. Now, the next thing should be debt financing. Now, debt financing is a lot quicker than equity financing, and it also means that you do not have to give up any control of your company. So they could perhaps take on some additional debt financing from the bank by selling some assets or securing loans against these assets. And finally, for really big projects that require huge amounts of investment, you should consider equity financing. Now, this is last because, of course, there are a lot of negatives to it, such as giving up control of the company. It's very expensive perhaps to do and it takes a long time, but it's the best way to raise significant amounts of funds. Now, for example, if IC Optical wants to raise $500 million C to buy out another large competitor, it's unlikely that any one bank is going to give them $500 million C because that's a huge amount of money. And of course, with bank loans, unlike dividends and the other costs associated with equity, interest payments are mandatory. Whereas you could take on additional equity funding and not have to pay it back, at least not immediately. You do have to pay loans back. And of course, the interest on a $500 million C loan would be enormous, and that would affect those margins more than the loans they currently have already do. And so the kind of theories that you can use when you're talking about funding are things such as the dividend signaling theory. Now, I've already explained to you what that is. That's where you create an impression on the market and shareholders by paying out dividends. Now, it's not always a good thing for a company to pay out dividends, even if you may think as a shareholder surely you would want them. And of course, also learning the advantages and disadvantages of debt against equity. Now, I've put a few here for you, such as that debt is quicker, it's cheaper, but of course with equity you can raise a larger amount and you do not necessarily have to pay it back. Now, my issue number 9 is a management or staff issue. Now, the reason why I've brought this up is, again, it's another common issue. And in the management case study exam, almost 40% of your marks relate to people and leadership skills. And this is one of the best ways of testing those people and leadership skills. And finally, when we went through the pre-seen, we did learn that it is a very labor-intensive organization. The management and the trained optometrists, etc., are all crucial to the organization. If a load of their qualified optometrists were to leave, then there are lots of things that the company would not be able to do, because administering eye tests and recommending glasses, etc., are tasks that can only be completed by qualified optometrists. So likely issues that come up would be, say, a key member of the board leaving. And I've given you an example here of Jerry, this experienced CEO. If he were to leave, would that leave the company in a situation where it was without decent leadership, it lost its direction? And also Andrea here, because he's the head of the research and development department, and it mentioned in the pre-seen that he was the driving force in a lot of the innovations that the company has achieved. So if he were to leave, where would that leave the company, given that research and development is so crucial to the continuing success of the business? And I've also put here some issues relating to staffing. So if the qualified optometrists within the organization were asking for pay rises or threatening to leave, if they were, say, unionized, for example, then what effect could that have on the company? Obviously, you don't want to cow down to any threat from your staff, because that would put you in a weakening position in the future, more likely to have more issues. But at the same time, we cannot afford to have all our qualified staff leaving. And ways in which we can keep our staff on board is by giving them quality training. And again, another issue that was identified in the pre-seen, which relates both to growth of the organization, if the organization continues to grow rapidly, and also that relates to qualified staff leaving, is recruiting suitable people. Now, we know that it takes several years at university to qualify as an optometrist, and then you have to have another few years of working as a junior optometrist before you are qualified. So there is quite a long process required for people to become optometrists. So if there was a situation where there were not that many available optometrists, it could take a long time for more optometrists to become qualified and employable. So that's always an issue when you're dealing with highly qualified personnel, is that sometimes there can be a shortage of available staff. So points that you should bring up here. So reasons to keep key management. This relates more to the directors. If we lost Jerry, we know he is experienced in the industry and in the CEO position. We know that research and development is so important to IC Optical. And if they were to leave, how easy would it be to find replacements, and how effective would those replacements be? And of course, as a listed company, whenever a senior member of staff, one of the key members of the board, leaves, it could affect the share price. If a CEO leaves, usually the share price within an organization plummets. And the next one here, importance of staff. This relates more to the qualified opticians. So it's critical to customer service and critical to the service we provide, which of course we know is the critical success factor of the organization, and also critical to the basic operations of the organization. If you remember, looking back at the pre-seen, one of the first products that every customer in a sense pays for or comes in for is the eye test, which is then invoiced to the government. Now, we cannot administer eye tests without qualified opticians. And of course, even though that was only a small percentage of revenue, without that initial eye test, the revenue from selling frames and lenses would not come, because we would not be able to prescribe glasses for those customers. And some key theories you can use here are things such as the Mendelow's matrix, which is the stakeholder matrix, and the directors are key players to the organization. So they have a high interest and they have high power. And this of course gives them extra power if you are negotiating a new contract. So you have to think about that. You cannot play fast and loose with your directors if you are negotiating new contracts for them, because they are so powerful. And I've also put here some theories about motivation. If you want to keep your staff motivated, you could look at doing some of the following, such as giving them challenges, promotions, recognizing their achievements. And that will, of course, motivate them. And a motivated employee is a happy employee, and a happy employee is less likely to leave. So I hope you've enjoyed this sample video and more importantly found it useful. Before I go, I'd like to quickly tell you about a few of the products that we do here at Astranti Financial Training, specifically for our case study courses. We have a study text which details all the key theories in which you will be expected to use in your case study exam, as well as details of how to approach the pre-seen and the case study. We also have a series of course videos detailing how to answer case study questions. This is actually an area in which many students struggle. Most of the scripts that I've seen, the failing scripts that I've seen, has actually been due to poor case study technique rather than lack of knowledge. We also have a series of pre-seen analysis videos based on the current up-to-date pre-seen, detailing all the key bits of information and likely issues you may face in the exam. Next up is the industry analysis, a pack detailing information about the industry that the pre-seen company resides in, information about the key players within that industry, and more background information on the industry in general. We also have a range of mock exams created for each level and based on the current pre-seen, which is a great way to get some practice in before you sit the real thing. We also offer marking and feedback on those mock exams so you can see where you are going wrong and where you can improve. Finally, we have the master classes. These are 2 one-day classes taken by our expert tutors to give you all the hints and tips you need to really add to your chances of passing the exam. Also, if you take our full course, we offer a pass guarantee, which, provided you have met all the requirements of the pass guarantee, you will get a free resit on the next exam should you fail to pass. So once again, thank you for your time. If you're interested in any of these products, please visit the website www.astranti.com for more information. Thank you.